Hi there, Etoro. It is Monday, the 14th of November, and that means it's time to take a look at what moved the markets last week. This video is going to be short and sharp. I put out a fair amount of content last week, and actually I wanted to do the same this week by putting out more written posts. So jumping into it, there was quite a crazy rally across US equities last week. So you can see the NASDAQ from Friday to Friday last was up 9%. The S&P 500 also had quite a nice jump, not to the same degree, but it was a pretty chunky monkey. The CSI 300, so the Chinese equity market, has also been doing quite well, and I'll talk about why in a moment. And as we would expect, given the rally in equities last week, bond yields in US Treasuries dropped off quite a lot, and I'll talk about why in a moment. Now, I don't think anyone needs to be told that the reason for the enormous rally was that the inflation rate in the US came in much lower than was expected. And what's quite funny, I know that I spoke through this chart last week, this model that I have of inflation data in the US, year-on-year inflation versus the interest rate. The number came in more or less where I had pinpointed it in this model. Now, the fact that I got it right doesn't mean that I have a crystal ball. I'm just working with probabilities here, and the probability at this particular time happened to be bang on correct. However, going forwards, while I think that the average month-to-month inflation will be 0.3% or lower, probably lower, we're not going to see this month-to-month. It'll be a little bit higher sometimes, a little bit lower. After that, it's going to be kind of lumpy, but we wanted to head in this direction where the average over this period ends up being 0.3% or lower. So given where CPI landed last week, it now seems a lot more certain that the Fed is going to raise interest rates in December by 0.5%, 50 basis points. And that's part of what the market is celebrating, the certainty around the smaller increase. I think that there is a decent chance that that will be the last of the big increases that we see for a while in interest rates. They'll slow down and become smaller. And if that were to happen, then I think that the Fed pivot window remains somewhere within this period, somewhere within spring of next year. Now, it's all good and well when your portfolio is up 10% or more over a period of 2 days, but we need to remember where we are in this cycle, the tightening cycle, economic cycle, etc. No doubt certain equities have been enormously oversold, but where are we? So peak inflation might be behind us, and it looks as though it might drop fairly quickly through the next 3 quarters or so. The fact remains that the Fed and other central banks are still tightening. On top of this, while companies are beating their EPS estimates when announcing earnings, we must bear in mind that these earnings have been revised downwards every single quarter for the past few quarters, and that's likely to continue to be the trend going forward. So economic conditions are becoming a little bit more difficult for growth, and we have the Fed that's tightening and other central banks that are tightening on top of that. The last point to remember is that the economy is still feeling the effects of the last 6 to 9 months worth of tightening effects. And all of this information together makes me think that we're in a bit of a bear market rally right now. I don't know how long it goes for. I don't know what height it reaches. I don't know how far it drops on the other side of this bear market rally. Maybe it chops sideways from here. But I do not think that this is the time to be aggressive in thinking that this is the beginning of the next bull run. I don't mean to be a wet blanket. I think that things are going in the right direction. It's just not the time to become incredibly bullish just yet. All right, let's drill down into the CPI number a little bit more. The reason I'd like to do this is because it becomes more apparent where the sticky elements are within the CPI number, as well as what has been improving. So we're looking at this bar on the far right, and everything below the 0% line dropped in price. This, of course, is great news. They're dropping from a very high level, so things are still quite expensive. But we can see that transportation goods, so used cars, for example, have been dropping in price. That was one thing that went up enormously in price through the pandemic. We can see that medical care services are also dropping. Apparel has dropped a bit. Household supplies, all fantastic news. But for me, the most interesting element of this chart, this particular bar, has to be the green chunk, which is obviously the largest part and happens to be shelter. The reason that this is interesting to me is that, one, it's a huge contributor to the CPI number, but two, it is likely to trend down significantly over the next 6 months. The rise in interest rates has slammed the brakes on in the housing market, and so we're still seeing the effects of that follow through within the real economy, but I think this will be one element where we will see it, and that's pretty good news for the inflation number. Last week, we also saw the midterm elections in the US, and this turned out to be a nothing burger, I think, like most people expected. The result is balanced, which is pretty good news, I guess. Moving on to China. So it looks as though Beijing has been reiterating its commitment to the zero COVID policy, but it's saying one thing whilst easing those measures in the background. I did suspect that this would happen after the National Congress because they want to put out these big, strong political statements, but actually they also want their economy to grow. They understand that this is a challenge. They're very clever people. They've, run the country very well for the past few decades, and they understand that something needs to be done about this problem. So this is good news. But it is just the start. The second bit of big news out of China, and I'm not sure about this headline from CNN, but the Chinese authorities have put out a 16-point plan aimed at supporting the economy and targets the real estate part of their economy specifically. Real estate is an enormous part of their economy, and the government has had a lot of trouble in creating confidence in this area. There have been lots of other smaller measures, support measures that have been put out through the whole of this year, but this is by and large the biggest of those support packages. And quoting from this article, the rescue package is viewed by many analysts as the strongest signal yet from Chinese authorities that the 2-year crackdown on the sector is now over. This does not mean that they're going to turn around sentiment like that, but it is, once again, the start, hopefully, of changing sentiment within the Chinese economy. All right, so what's happening this week? Well, we have the G20 summit happening in Indonesia. I don't think that anything is going to happen at the summit that's going to create a lot of volatility in the market. I would say the most interesting aspect of this is that good old Joe and Xi are going to meet face to face for the first time. We've also got quite a lot of interesting macroeconomic dates coming out. So we have the PPI number out of the US tomorrow, and this is a leading indicator versus the lagging indicator that CPI is on inflation. I think the market will also be looking quite closely at this initial jobless claims number out of the US on Thursday. This is because the Fed is watching inflation as well as the employment or unemployment picture within the US very closely to determine its plan going forwards. On top of that, we have CPI data out of the UK and the EU, which will be very, very interesting to me personally. On Thursday, we will also get the autumn forecast statement in the UK. This is probably the most interesting thing that's happening in the UK this week. Hopefully this goes better than the last mini budget, which completely collapsed the pound, I don't know if you remember, and resulted in the Prime Minister basically getting fired. In this meeting, we'll learn more about how the government plans to fund the economy, what it's going to do about taxation and that type of thing. And finally, I will put out a written post about this, but I'm going to cut my holdings in Booking Holdings and Booking.com. My thesis here was that Booking.com would see a huge influx of customers and therefore revenue through this year. I've been holding my position since January, and that has most certainly been the case. The last earnings report was very good, but the reason that I want to drop this position despite the good news is that I think that Booking.com is going to have a bit of a tough year next year. And although I do expect there's a lot of upside left for this company, let's say 20 to 30% of the next 12 to 18 months, there are other companies out there with a similar or better risk profile that I think could see returns of 50% or more in the same time frame. Long story short, it's still a good company. It's just that the landscape has changed and there are better opportunities elsewhere now. All right, that's it for this week. I'll speak to you soon. Have a great one. Goodbye.